Get going. So let's assume that your goal is to live on passive income and you don't currently have enough money to do that. I've got a plan I'm doing for myself that involves 3 phases. First step is to buy certain growth stocks. Then I wait until those growth stocks grow big enough that I can harvest or take out an annual income without losing all my money on the long term. So a specific example is if I had put in money in 2011, let's say $100,000, then 10 years from then, I would have well over $3 million, which would be enough to take out $280,000 a year, and my growth from that point would continue to be positive of my portfolio, even in 2021 when the value fell by half, let's say. So the value in 2021 would have been 5 million, falling by half would put me 2.5 million. I would still take out my annual pay, even though I had just lost half, and it would continue to grow. So I'm in the middle of doing this, and here's how it's going so far. In 2021, I put in money, and then you can see in 2024 that I have a lot more money. I have 75% more money. That's over a 3-year period, and including a very significant crash where my value of my stock dropped below what I had started with. So I count that as working. This growth rate is a lot higher than your typical Vanguard or other index or even aggressive growth portfolio. And the key difference here is that in good years, it goes way up compared to those. In bad years, those portfolios go down, and ours goes down more. And once in a while, a lot more, but not on average. On average, it does much better. And it's not really why our return rate, which I'm conservatively calling 30%, but actually is higher, somewhere between 30 and 40, is much higher than most sort of references for aggressive growth, which usually around 15%. So I'll get into why in a minute. The basic reason, as far as I can figure out, is that most portfolios include a lot of diversity, and there are only a few stocks that perform at these really high levels, about 30% or higher annual average growth. And they're very volatile. They go up and down much more than other stocks. But their average is up much higher than other stocks. I think most portfolios aim to reduce that volatility by buying other stocks that don't go up and down as much, but the average performance is so much worse that it seems to me like a bad deal. There are a few that are basically based on FANG, which is an acronym for Facebook, Amazon, Apple, Netflix, and Google, which FANG is a pretty good proxy for what we're doing, which is just buying big tech stocks that have very high average annual growth. And as the slide says here, there are some rules those funds have to comply with. But those few funds like FNGU are producing returns like ours. So looking more specifically at what we are buying and selling, it's a lot of basically just big tech stocks. These are all publicly traded on NASDAQ. And I picked out a few others I try to diversify, but never with anything that doesn't perform extremely well. So I did find a few companies that are performing at very high average annual growths over a long period, as shown there. But most of them are the usual suspects: Microsoft, Google, Tesla, NVIDIA, Netflix. Adobe is on the list. So this wall of numbers is easy to read if you just look at the colors. So the bright green represents exceptional growth, So, for example, you can see that a company called Enphase, which makes climate tech hardware, had massive growth in 2019 and 2020. It also had pretty amazing growth other years, but there have been some years where it just absolutely killed it. 500% growth in one year. And you can see that other companies like Baidu have had, tripled stock, 254 growth in 2007. And then the more anemic growths are still really good. Like in 2013, it grew 73%. The color there isn't too bright because that's not too extreme compared to some of those others. You also notice these vertical red columns in 2008 and 2022 where all the stocks fell. You also notice the amount in the dark red is nowhere near the amount in the dark green. So that's the difference I was talking about, where the growth is much higher than the shrinkage. And the other thing to notice is down the bottom where it says indices. That top row says Vanguard ID Tech Fund. This is a common reference for an aggressive growth fund. You notice there's no dark greens anywhere in here. The highest growth they had was 46%, 63% in 2009. And you also notice it's a fairly new fund. The pound NA means the fund didn't exist back in 2004, so I don't have data for it. Similarly, NASDAQ 100, which is the top 100 stocks in NASDAQ, they had a couple years of 101% growth in 1999 during the boom, but none of those are anywhere near the best stocks on NASDAQ, where we had 300% growth, 500, and so on. So, yeah, and then your other basic funds like Dow Jones Industrial Average, they're nowhere near these numbers. But their falls are. The negative numbers in the negative years are just about as bad as the negative numbers in every other tech stock and index fund. So we all have the same bad years, but some stocks have really great good years. And that's the key of what we're doing here. All right. So the hard part is not picking the stocks. The hard part is waiting once you pick the stocks. Because if you have highly volatile stocks that are going way up and way down, you have to be patient in order to get the market growth. So this is not a bet that Apple will suddenly invent something amazing and that you're going to catch that moment. This is a bet that in general, Apple does a good job of capturing tech innovation value, and that if you hold Apple stock for a long time, eventually they'll hit on something. And if they don't, Microsoft will. And if they don't, Tesla, Google, Amazon, any of these big companies will. So you got to be patient. You got to wait years. And you also have to be able to sleep well at night, even when the stocks all drop by half. That's the hard part. How way I do it is I just really focus on this dotted line. I accept the risk and to get the reward. The reward is exceptional growth. So here, going from 100K to 400K in 5 years, that is way faster than any index fund. And the risk I take is that it's going to look like I got to 400,000 in 2 years, but actually, and then it drops back almost half down, and then it comes back. So it's up and down, up and down. My job is to ignore the blue line and focus on the dotted line. Yeah, which is really hard, like I just said. The key point is that I ended with 400K in 5 years. That is exceptional investment performance. And that is worth learning how to be patient if you need to learn it, like I did. So here's another way of saying that the longer you wait, the less other factors matter. Let's say you bought an aggressive tech stock of any kind, and then you sold it a year later. And let's just make the year that you bought it random. Some years you would have done amazingly. Okay, if you bought it in 2003, by 2004 you would have doubled your money in 1 year. Other years you would have lost half your money. Bought it in 2007, sold it in 2008. Now you have half as much as you started with. So you can see it's super risky compared to other kinds of stocks. However, that's not actually that risky compared to other kinds of stocks where you would have also lost a lot of money in that time period. But you would have lost more with ours. So the key is not to buy less risky stocks. The key is to wait longer. That was the lightest green, the tallest bars on this chart. The next pale green, gray-green color, the 2-year period, you can see that, look at the 2008 line, it's hardly any loss. If you just wait 2 years, you would have lost money, but hardly any. If you wait 5 years, that's the dark green line, there's no period since 2002 you would have lost money. In fact, the worst you would have done is around 12% gain, even if you happen to buy and have a crash. So waiting 5 years means you're very, very likely to make money. However, you have to wait 5 years. And 10 years, even better. The lowest you would have earned is 25% annual growth, which is more than double what most aggressive growth funds would have predicted. Okay, so let's talk about what decisions you really need to make if you're going to do this strategy. There's only really 3. How much money to start with? That'll shorten that long period. You see how flat the growth is from 2011 to 2015. The time it takes to double money keeps getting shorter as your money grows. It's a standard exponential curve. So if you can invest more, you can shorten the amount of time until you get to an amount that you can start harvesting. Obviously, you may not have more, so that may not be an option. Then, of course, how long you can wait. We just talked about that. And then when to start harvesting. When really you can I think of it as an amount. And basically, I think of my finances, my portfolios in 3 amounts. Not enough, as in, let's say, 100,000. That is not enough to take any money out of. Enough, which for me might be a conservative number, let's say is 3 million. And then too much, which is on the far right end of the graph, where I have more money than I'll ever use. Or in fact, I feel like it's harmful to my life to have that much money and to start thinking like I'm a wealthy person, because I don't really like being that wealthy. So at that point, I'd be looking at charities and major donations to keep my wealth where I want it and where I want my children's wealth to be. So when is not really when, it's more like how much is enough to start harvesting, and when I can stop working. Again, that little red block on top of 2020 represents the first year I started harvesting, or I would have started with this portfolio, and it represents $280,000 a year. You can see this insignificant amount compared to the portfolio value. So yeah, like I said in the previous slide, if you can put in 200K, you can essentially erase the first few years of waiting, because you started a higher amount and you're closer to harvesting. You can start harvesting earlier if you are more risk tolerant, and here's what might happen. Let's say you started in 2011 with 100K. Let's say you only waited 5 years instead of 10. So not because your 5 years are so amazing that you got to 3 million, but essentially because you wanted to stop work sooner, and so you stopped work sooner, started taking money out. Your portfolio grew even though you took out 280K, but you can see the 280K is a much bigger chunk of your portfolio. 2017, all good. It grew despite your big withdrawal. 2018, not so good. It dropped by half. And you get a little worried, so you say, okay, this year I'm taking out less. That smaller red block in 2018 represents 100K, not 280K. So you might have had to work part-time or come up with other money. But you don't take out 280K, because that would pretty much kill your portfolio. You'd be back to 2011. So this is what I might call varied harvest. You take out, if your portfolio shrinks down to some limit, let's say 600K, you start taking out less, or maybe even none at some point, until it grows again. So that's a way to shorten the waiting period, if you can be a little flexible on your retirement goal. Just hammering this point again, taking out money sooner does not lower the average growth. Taking out money sooner massively increases the risk of the portfolio losing you money. If you just put it all in and take it all out, you have a giant risk in a 1 year timeline. If you put in money and take it out over a period of time instead of all at once, it greatly reduces that risk, but not as much as waiting. Just putting the money in and waiting and then taking it out, either slowly or all at once. All right, how bad could it go? Let's say that we put in 100K in 2000 and we then caught the global financial crisis in 2008. Our investments went in half. Not only did they go in half, they stayed down for many years after 2008 compared to their average performance. This is how bad it would have been. In my view, this isn't that bad. I did have to wait longer to get to my growth target. But my average annual growth, that green dotted line is 30% average annual growth, still did happen. It just took longer. I had to average over a longer period of time. It is not that the average was wrong. It's that the time period required to hit that average grew. So the Western world did not collapse. Tech stocks did not stop innovating. People did not stop investing in them. They just took a break. So I had to wait many extra years over the worst period since 1992, 6 extra years, to get my average growth. To me, that is a very acceptable risk, if that is absolute worst case in my adult life. All right. If you were to actually do this, this is basically how you do it. It's really not that much of your time to do. Probably consume a total of 8 hours if you were focused on it. Like I said before, you decide how much, how long you want to wait or can wait. Then you just buy the stocks, which is like opening a bank account if you've never done it. You go look at that slide I showed you with the percentages, buy those stocks, and then you wait and ignore. And then when your portfolio is above some amount, like maybe 2 million, whatever you decide, then you start withdrawing, selling a few stocks enough to generate your monthly income, let's say 2,300. And you just keep selling them every whatever month, quarter, year, and just live on the cash. So it seems like, when you're talking about big things that you might want to try it a little bit, experiment, put your toe in the water. One of the problems with this strategy is there's no good way to do that. If you put in a small amount, let's say $1,000, you have to wait a long time. That waiting is a significant part of your life. So you can, and you will earn $4,000 after 5 years. And you'll be like, oh, wow, this is actually working. And then you'll put in 100. So now you've waited 10 years. If that's all right for you, that's actually great. You can do that. But for most people, that's not great. What you can't do is just wait a year, because it'll just go up and down all over the place, and it'll feel like gambling, which it kind of is over that short of time period. You'll never notice the trend line, the dotted line, and you'll not do it in the end. Whether you get lucky or unlucky, you won't understand what you're investing in. That's it. That's all I wanted to tell you. And I'll do a separate recording over a bunch of what if slides compared to real estate, some more tips. How do I do my portfolio? What's dollar cost averaging and rebalancing? What are the underlying trends? So on. So, yeah, I hope this was helpful, and I hope that you contact me and that we, you find it interesting, I guess. Thanks.